The S Corporation is the quintessential baby boomer. Created in 1958 by adding subchapter S to the tax code, S Corps were to be distinguished from conventional corporations known as C corporations by not being subject to income taxes at the corporate level. Income would be passed through to the shareholders, who would be the ones paying the tax on the income earned by the business. Naturally, this was a welcome state of affairs because it avoided the double taxation that C corporations were subject to. C corporations pay a tax on their net income. Then C corporations' shareholders pay tax on that income once more when it's distributed to them as dividends. However, just like a C corporation, an S corporation provides limited liability. Both are legal entities that are separate from their owners, so their liabilities and their assets are their own. This means that S corporations' shareholders are not personally liable for any S corporation debts. An S corp can also be beneficial tax-wise compared to some other business structures. For example, with sole proprietorships and partnerships, all income is subject to employment taxes. However, with an S corp, only working shareholders pay employment taxes, which are based on the salary or wages they receive from the S corp. Passive shareholders do not earn a salary and thus do not pay employment taxes. Moreover, the distributions paid to both working and passive shareholders are not subject to employment taxes. So, there are many benefits to organizing your business as an S corp. But is an S corporation the right structure for holding real estate interests such as rental properties? We'll look at 3 reasons why it may not be. But first, we need to review the passive activity loss rules. The passive activity loss rules were designed to limit the deductibility of losses from passive activities against non-passive income. Under these rules, losses from passive activities can only be used to offset income from passive activities. Passive activity losses cannot be used to offset income from non-passive activities such as wages or investment income. For businesses in general, passive activities are business activities in which the taxpayer does not materially participate. However, rental activities are treated somewhat differently. Rental activities are considered passive activities even when a taxpayer materially participates in the business. The exception to that rule is when taxpayer qualifies as a real estate professional. In such a case, the passive losses from the real estate activities can be used to offset income from non-passive activities such as W-2 income. Okay, with that out of the way, let's look at the first reason why you should avoid using an S corporation to host your real estate interest. An S corp shareholder acquires basis by investing in the S corp. Now hold up, let's briefly discuss what shareholder basis actually is. Shareholder basis in a business refers to the amount a shareholder's investment in a corporation adjusted for various financial activities like additional contributions, share of income, losses, and distributions. It determines the shareholder's tax implications, such as the ability to deduct losses and the taxation of distributions received from the corporation. Maintaining an accurate shareholder basis is essential for proper tax reporting and compliance. If you want to learn more about shareholder basis, check out our other videos. Okay, let's move forward. The shareholder's stock basis increases with capital contributions and decreases when he receives profit distributions. Additionally, he may acquire debt basis if he makes direct loans to the S corp. A direct loan is a loan made from the shareholder's own funds. The requirement that an S corp shareholder only acquires debt basis in the S corp through direct loans from the shareholder is a major impediment to the S corp shareholders optimizing their tax position. Why? Because that limitation does not apply to partnerships. Unlike an S corp, a partner can acquire debt basis in a partnership even with a third-party loan, for example, from a financial institution. Let's walk through a simplified example to compare how debt basis rules operate in a partnership versus an S corporation and how it affects the ability to reduce taxes through loss deductions. Jack and Jill each have 50% ownership in their separate businesses, but the businesses are organized differently. Jack's business is a partnership and Jill's business is an S corporation. They both made capital contributions of $50,000 to their businesses. Also, the businesses have each borrowed $150,000 from a bank backed by the owner's personal guarantees and have run up losses of $175,000. Jack's initial basis in the partnership is his capital contribution of $50,000. Since Jack is a partner, he can increase his basis by his share of partner's liabilities. The partnership took out a loan of $150,000, and since Jack owns 50%, he can include 50% of the partnership's debt in his basis. Jack's share of the debt is $75,000, 50% of $150,000. Jack's total basis is now $125,000, which is $50,000 initial contribution plus the $75,000 of share of debt. The partnership incurs a loss of $175,000 and Jack's share of the loss is 50%, or $87,500. Since Jack's basis in the partnership is $125,000, which is more than his share of the loss, he may be able to deduct the full $87,500 on his personal tax return, provided he complies with the passive activity rules we discussed previously. To be able to apply the loss of $87,500 to the income from the medical practice, Jack must be able to qualify as a real estate professional. Jill's initial basis in the S Corporation is also her capital contribution of $50,000. In an S Corporation, a shareholder cannot increase their basis by the corporation's third-party debt. The shareholder must have made a direct loan to the S Corporation. Even though Jill personally guaranteed the corporation's loan, this does not increase her basis. Therefore, Jill's basis remains $50,000, which is her initial investment, and she does not receive any additional basis from the corporation's debt. Now, when the S Corporation incurs a loss of $175,000 and Jill's share of the loss is 50%, or $87,500, Jill will only be able to deduct $50,000 because $50,000 is her basis. The remaining $37,500 of the loss is suspended and cannot be deducted until Jill either makes additional contribution or lends money directly to the S Corporation. This example highlights how the partnership provides greater tax flexibility when it comes to using debt to increase basis and deduct losses compared to an S Corporation. How do the passive activity loss rules apply to basis? In our previous example, both Jack and Jill appear to be in a position to use losses from their passive real estate income to reduce their taxable non-passive income. Unfortunately, that would generally not be possible. As we already noted, passive losses cannot be used to offset non-passive income. The exception is where the taxpayer has acquired real estate professional status. Another disadvantage of holding real estate property behind an S Corporation is the punitive tax treatment that capital contributions may attract. When a shareholder contributes appreciated property to an S Corporation and ends up owning less than 80% of the corporation's voting power and value after the transfer, the transaction will attract capital gains tax at the time of contribution. However, under Section 351 of the Internal Revenue Code, the realization of capital gains can be postponed until the shareholder disposes of their interest, but only if the shareholder owns 80% or more of the S Corp stock immediately after the contribution. Once again, we will compare the disadvantages of an S Corp to the partnership with an example. John owns 70% of an S Corporation, and he decides to contribute real estate with an appreciated value to the corporation. The original cost or basis of the property was $200,000, but the fair market value at the time of contribution was $500,000. John will receive additional shares in the corporation for his contribution. Because John owns less than 80% of the corporation's stock, his contribution does not qualify for tax deferral under Section 351. Therefore, the $300,000 capital gain in the appreciated value of the property takes effect at the time of contribution. Had John owned 80% or more of the corporation, this transaction could have qualified for tax deferral, and no immediate gain would have been recognized. John's tax position could potentially have been more favorable if he were a principal in a partnership rather than a shareholder in an S Corporation. That's because under Section 721 of the Internal Revenue Code, when a partner contributes appreciated property to a partnership, no gain or loss is generally recognized by the partner at the time of contribution. This is true regardless of the partner's ownership percentage. In other words, John would have not had to recognize $300,000 gain immediately upon contributing the property. Thus, the tax on the gain would have been deferred until the property was sold or some other taxable event occurred. Transfers of an interest in an S corporation are not eligible for a step-up in basis. A transfer can occur when a shareholder sells his interest or that interest is passed to a beneficiary when they die. This means that the transferee who receives an S Corp interest and later disposes of the property behind the interest will have to pay capital gains tax if the property is sold for a higher price than it originally inside basis. So what's inside basis? Though those terms sound very technical, they're quite simple to understand. A step up in basis is simply an adjustment of the value of an asset at the time of death. Inside basis is the value of the assets owned by the business. Outside basis is the value of the owner's share in that business. Let's see how these concepts work with an example that contrasts the differing tax treatments of S corporations and partnerships. Assume that the original cost of real estate held by a business is $400,000 and that its current fair market value is $1 million. Additionally, assume that 100% partner or shareholder Jack sells his interest for $1 million to Jill and that original outside basis in the business is $200,000. The sale results in capital gain for Jack of $1 million minus $200,000, which equals $800,000, since his outside basis is $200,000. Jill's outside basis is now $1 million, but the corporation's assets still have an inside basis of $400,000. There's no adjustment to the inside basis. Suppose now that the S Corp sells the assets to a third party, again for $1 million. It would have to recognize the capital gain of $1 million minus $400,000, which is $600,000, which will be passed through to Jill. As a result, Jill will be liable for capital gains tax on $600,000. In similar circumstances, a partnership has the option to make a Section 754 election. This allows not only just the outside basis, but the inside basis to be stepped up to $1 million when Jack sells to Jill. So when the property is sold to a third party of $1 million, there's no capital gain and Jill will not be saddled with a capital gains tax. So now you know why organizing your real estate interest as an S Corp is not the best strategy. The S Corp structure limits the use of debt to increase basis, limits options for tax deferral, and limits step up in basis when interest in the business changes hands. So what are the best options for real estate? A simple single-member LLC or partnership is the best answer to avoid a lot of these S Corp problems. For information on how you can optimize a tax strategy that incorporates your real estate ventures as well as your medical practice, schedule a free tax discovery session. Also, if you found this video helpful, don't forget to hit the like button and subscribe to the channel to stay up to date on all of our new videos. If you would like more details on some issues or if there are any new issues you'd like to hear more about, drop us a line. Comments are always welcome.